Good afternoon, and welcome to the State of Low-Income Housing Tax Credit Market, National and Local Perspective. This website is a joint presentation with Ballard, Spahr, and the Arizona Housing Alliance. I am Ginger Perry, a partner in Ballard Spahr's Phoenix office. With me today are Valerie Iverson of the Arizona Housing Alliance and our four presenters. My colleagues at Ballard Spahr, Wayne Hykan, Ellen O'Brien Kauffmann, and Mark Michael, and from Aslar Enterprises, Quinn Gormley. Valerie, Ballard is pleased to be able to present this webinar on behalf of the Arizona Housing Alliance. Would you like to say a few words about your organization?
Yes, thank you, Ginger. Good afternoon. I'm Valerie Iverson, Executive Director of the Arizona Housing Alliance, and I want to thank Ballard Spahr for hosting today's webinar. Arizona Housing Alliance is a statewide nonprofit organization dedicated to supporting and advocating for quality housing that Arizonans can afford. The Alliance was formed in 2008 to provide a unified, influential voice for resources and policies that create more housing choices in Arizona, and to be a one-stop shop in the state for affordable housing information and education. You can find more information about our organization at www.azhousingalliance.org. Ginger?
Valerie, we'd like everyone to know that this presentation will be posted on Ballard Spahr website and on the Arizona Housing Alliance website tomorrow for future viewing. The program is worth one Arizona continuing legal education credit, and a certificate will be sent via email to all of today's attendees. Should you ask questions during the presentation, you may do so by using the Q&A panel on the left side of your screen. We will allow time at the end of the presentation for questions. If you have not answered all of your questions in the time allotted, the presenters will follow up personally. Next, introduce our presenters and then proceed directly to the presentation. Hykan is a partner in Ballard Spahr's real estate department and chair of our tax credits practice. He focuses his practice on real estate and finance transactions, especially those involving affordable housing, mixed-use development, and community development. He represented developers, commercial lenders, and investors in real estate finance projects, including mezzanine debt, tax-exempt financing, and public-private partnerships involving low-income housing tax credits. Ellen O'Brien Kauffmann is a partner in our real estate department as well, and a member of the housing and tax credit groups. She concentrates her real estate practice on representing developers and investors in affordable housing projects. Her practice also includes structuring and syndicating affordable housing projects with tax-exempt bonds, historic tax credits, and low-income housing tax credits. Her experience also includes loan workouts, foreclosures, and restructuring of partnership interests for projects financed with and without low-income housing tax credits. Michael is of counsel in our real estate department and a member of the housing tax and tax credits groups. He focuses his practice on providing tax advice to investors and syndicators who invest in real estate projects that generate federal and state income tax credits, including affordable housing properties developed with low-income housing tax credits and historic buildings renovated with historic rehabilitation tax credits. Gormley of Aslar Enterprises has 17 years of community development experience. The majority of his experience has been gained through affordable housing activities in multiple states. He's worked as a real estate development project manager and as manager of state and federal resources. Additionally, Quinn has originated low-income housing tax credit investments in 21 states and provided various debt structures that facilitated the development of Community Reinvestment Act target projects. And now, shall we go on with the program? Wayne?
Good afternoon. Before getting into the sessions where we discuss the current state and future in the affordable housing area, I wanted to spend a little time discussing what we recently have gone through as an industry and set the context in which for the current environment. But perhaps the key thing that happened in affordable housing was just realizing how closely linked it was to the credit markets overall. And when the credit crisis hit, even affordable housing was a highly subsidized industry and one that would seem to be relatively immune to general credit problems, the magnitude of the credit crisis severely impacted affordable housing. So for a number of reasons. One was that the affordable housing product, the low-income housing tax credit, requires that there's a purchaser, a tax credit investor, that has tax credit capacity. The ability to utilize the credit requires that the investor have current income against which it can offset used tax credit. When the major problems arose in the credit markets, all of a sudden assumptions about using the tax credit changed. For 20-plus years, it was taken as a given that major institutional tax credit investors would have no problem with tax credit capacity. Most notably, Fannie and Freddie Mac, who comprised over 40% of the market, had gone from being in a place they could use tax-deferred assets to being unable to use them at all. And exit to the market in itself was a major event. Other investors, such as AIG, lost tax credit capacity, and even those investors who had an income and could use the credit still faced a situation where there was uncertainty about the tax credit, but their own income-producing ability generated into the future, and the tax credit became much less useful and much less valuable. Another issue that was a part of the general crisis in the credit area was the acceptable terms for holding investments shortened. The nature of the tax credit investment is that the credits are allowed over 10 years and earned over 15. So an investor is subject to some loss or recapture of tax credits all the way up to 15 years after it's an investment. This is not a good fit in the current credit environment where investors became risk-averse and wanted to shorten holding periods. And the third, there was a general aversion against real estate risk and risk in general. That aversion, while has been subdued since the end of the credit crisis alleviated, but it's still much greater than it was before the credit crisis began, and we still see lots of examples of interludes of credit aversion such as we've had over just the last few weeks. There's some very good discussions about the history of what happened and what the nature of the problems. Two of them I point out to you is the Harvard Joint Center for Housing Studies report, The Disruption of the Low-Income Housing Tax Credit Program. That's a mix of a study and it appears to me a bit of an advocacy piece for what needs to be done on a going forward basis to revive the credit market. And also the Low-Income Housing Tax Credit Investment Survey by Ernst & Young. That's another survey that was undertaken by the industry and has recommendations about what would be useful. The suggestions coming out of the industry have not been fully embraced by and not been enacted by Congress at this point. The major piece that is considered to be very helpful would be to have a 5-year carryback for the credit so that the credit could be used against prior losses. And that, under the Ernst & Young report, was seen as revitalizing the credit market, which was slumping so badly. There were other suggestions in there, too, such as passive loss relief. In the meantime, though, the government did include some relief for the tax credit world in the American Reinvestment and Recovery Act of 2009. There are three notable pieces to that. One was the Tax Credit Assistance Program. That provided $2.25 billion of funding, usually in the form of loans, for projects as a gap filler That was considered an emergency measure. There are no realistic prospects for the extension of that program. It's pretty much off the radar, a program that could be available in the future. There is, however, the Section 1602, or the Tax Credit Exchange Program, which also is a gap filler and a bit of a stopgap measure to deal with the plummeting prices in the tax credit market. This program allows a developer or a public entity to, like a developer, to exchange what otherwise would be credits to the housing agency for cash. Some of the deals can be done in combination with other funds, including tax credits, or they may be done on a standalone basis. That program is over. It's a main part of extender discussions that will be discussed shortly in our program. Third aspect of the housing, the ARA, the American Reinvestment and Recovery Act of 2009, was that substantial funds were provided for public housing and has been relatively successful in facilitating modernization of the nation's public housing stock. Thank you. The next slide I want to point out is how these investment rates and the fluctuations we've had in the general markets relate to this relatively narrow world of tax credits. On the top line, an indication of, or data points showing what the applicable percentage is for 70% present value deals, or so-called 9% deals. These are the deals that are allocated credits by the Housing Credit Agency. That shows that it's bouncing around above 8% until third quarter or late second quarter of 2008, and then it jumps to 9%. That jump is not an interest rate fluctuation, but rather reflects Congress's HERA bill, where it set temporarily through 2013 the 9% rate at a true 9%. That resulted in a substantial increase in the amount of equity that can be generated by a project, and although I can't say it cushioned the blows from the credit crisis a great deal, at least it was one helpful fact. On the second below that, on the blue, is each data point shows the so-called 30% present value credit, or the 4% credit. These are for bond finance transactions or deals involving acquisition of an existing building. Now, Congress did not elect to increase and lock the percentage at 4%. So you see a big widening in spreads between the value of a 9% deal and a 4% deal, and that widening of spreads was one factor in making it very difficult to get 4% deals done in this environment. The interesting yellow line with lots of bounces on it is what's happening on the 10-year Treasury, and is probably the best surrogate for the mortgage rates in general. You see the very precipitous drop at the end of 2008, and then a very kind of an increase over time, and then perhaps most interestingly is just in the last month a very steep drop in that credit rate. There are a number of aspects for it that's important to the credit industry. One is that it shows how the 4% is going to affect how the 4% number is calculated, and thus the amount of 4% credits that can be done from a deal. But then it also, perhaps more importantly, tells us something about availability of funding for homes. And at the current rates, home mortgages are under 5% if they're, Fannie Mae or Freddie Mac types of mortgages. And that really highlights another issue that we've been struggling with, which perhaps is good for people across the country in an otherwise bleak economy, and that is mortgage rates are very affordable, homes are very affordable, but it calls into question what's the best use of tax credit subsidy in a world where there's a surfeit of affordable housing and extraordinarily low mortgage rates. What's emerged in the last year or so, and the first signs of kind of revival, primarily emanated from the banks. They were the first ones to return to the market in force, largely driven by the Community Reinvestment Act. They had lots of motives to invest. They also had complementary products such as construction loans. They had the infrastructure in place to continue to do deals, and they re-entered the market, albeit at lower prices than they had been doing before the credit crisis hit. So it's been this kind of the stalwart and the bridge to kind of where we're at now, but again, they're also yield-driven and they have lowered prices. The days of deals in CRA markets where the CRA justifies a price over $1 of credit are and don't look like they're coming back anytime soon. The attribute of the banks is the fact that there's such low rates allows them to return to profitability, and the banks, predominantly larger institutions, do appear profitable and can project income, so they have the tax capacity. So that brings us to where we're at, and I'll turn it over to Ellen for the hopeful notes on deals that are getting done.
Hi. On the deals that are getting done, what we're seeing is we're seeing that the 9% deals continue to be much more likely to get done than the 4% deals. And the reason for that is manyfold, many of which Wayne covered: the spread in the 10% credit versus the 4% credit rate. The 4% credit, those deals, there's a lot more real estate risk, there's a lot more debt on the deal, and so investors are still looking to close 9% deals over the 4s. In addition, the investors don't like the 4% deals for accounting reasons. They have to include all the debt on their balance sheet, and that doesn't look good. On transactions, when you compare 100% low income versus a mixed-use deal, many more transactions are structured as 100% low income, and that's just because then there's more equity and less debt on the project. Investors are really looking at real estate markets. Geography is key. Is the project in a flyover state? Is it in a CRA-driven state? Is it next to the coast? Is it middle of the country? The coast and New York, Florida, those types of places, deals are getting done, more likely to get done than some of the flyover states. What we're finding out is that the investors really are looking at well-capitalized developers and developers with a strong track record. Developers proven themselves in the past and successfully addressing issues. And this, I think, is interesting. For years, the QAPs in the states gave points for developers who had no experience, and that's really proven to have been a problem in the tax credit industry. Investors really want a developer who can come to the plate, perform under their guarantees, have a capitalized balance sheet. The investors are being very conservative in their underwriting standards. The rents, trends on vacancies, all very conservative, asking for operating reserves, long-term guarantees for operating deficits and things like that. There is some certain acquisition rehab deals that are getting done. I mean, Section 8 property continues to be lucrative for investors. And more about preservation deals later on. Some of the deals that we've all seen that are getting done are deals with housing authorities. And Wayne has had some experience and was going to talk a little bit about a deal with the New York City Housing Authority.
Yes. The financing of public housing has been a real bright spot in what's been a difficult time in the tax credit industry. There are a number of reasons for that. One is that the stimulus legislation was relatively more generous to public housing than it was to the tax credit program. There's quite a bit more money devoted for modernization, and the HUD has been supportive of allowing public housing to be owned in public-private partnerships to finance the modernization of that housing. And what happens in that structure is that the public housing money gets leveraged, including capital funds, financing programs dollars, with tax credit equity, and that combination of resources kind of builds on itself and allows a lot more money to be available for modernization. These certain qualities that are very appealing to investors in this market. One is they generally have very little or no must-pay debt, unlike the classic 4% bond deals from years ago, where there was typically a lot of debt and it had to be paid on a certain schedule or there was a risk of default. Often these public housing deals have essentially no debt that can be foreclosed upon during the entire 15-year compliance period. Among the most prominent and largest of the public-private deals is the New York City Housing Authority transaction, which closed in March 2010. We had the opportunity to represent LIHTC in that transaction. In that deal, they were able to finance the modernization of over 14,000 units. They were able to attract over $200 million in private equity to make that deal happen and to improve the housing. The investor city was motivated, in, I'm sure, in no small part by Community Reinvestment Act considerations as well as yield considerations. So in a market where there's lots of volume cap, but the economics of deals are adverse to typical deals, these public housing mixed finance types of transactions can really shine and be a way to use volume cap and get housing modernized.
The area of deals that are getting done are low-income tax credit deals with energy credit projects, and Mark was going to talk to us about that.
Yeah, recently we've seen or have worked on 5 or 6 deals that have either closed or in the process of closing that have involved a combination of low-income credits and energy credits. Typically, these deals involve solar panels or that provide electricity for a project or thermal pump equipment to provide heat and cooling for project buildings, and those kinds of equipment generate federal energy tax credits. Energy credits are investment tax credits like historic credits with many similar rules. And investors, because they've routinely worked with projects that combine historic credits and low-income credits, they're very comfortable with transactions that combine energy credits and low-income credits. Also, energy credits like historic credits are claimed immediately in the year the energy equipment is placed in service, and that will result in a higher internal rate of return to the investor on the project, resulting in generally a little slightly higher credit pricing for such projects. We've seen a couple cents higher credit pricings in deals that have combined low-income energy credit projects. These are going to become more frequent because many housing credit agencies have provided bonus points for green building practices. Even if you don't have an investor who wants the energy credits, there are also opportunities to incorporate those energy credits into your project without the investor equity. In Section 1603 provides for a grant in lieu of energy credit where you can get a dollar-for-dollar credit on the equipment that you placed in service, on the amount of the credit that was placed in service. But to be aware of this, there's a lot of important deadlines for grants in lieu of credits. The energy property has to be placed in service in 2010, or the construction of the energy property must commence in 2010 and must be completed by the credit expiration date for the particular energy property, which is generally December 16th of 2016 for most types of energy equipment. One of the areas that people are interested in is pricing on these tax credit deals. Where are we? Many feel that 2010 will be significantly better on pricing. We're seeing yields are really stabilizing between 11 and 11.5%. The pricing it really depends on geography, as well as the investors looking at where they would do deals. The pricing will change. We see there's a bifurcation depending on whether the project is in a CRA-driven state or a flyover state. There's a much higher yield in the non-CRA places because the price is much lower for the tax credit. Participating syndicators that have reported to an Ernst & Young reported prices right now are ranging anywhere from 58 cents to 82 cents. New York is the highest. South Florida and California we're seeing in the 80s. Texas in the 70s, and everywhere else pretty much between 65 and 70 cents. We're seeing areas that are showing increased interest, including Minnesota, Virginia, Maryland, and Arizona.
Ellen, may I speak to one aspect of that flyover issue, because it's both a CRA footprint issue, but it's also an economic issue. I mean, we in the industry have tended to focus on the tax credit aspects of the transaction and pricing and kind of yield-driven considerations, but there's massive impact from the housing markets overall. And some of the flyover states are not only not attractive from a CRA perspective because deposit bases aren't there, some of them just don't really need housing because, if you take as an example the city of Detroit, they're bulldozing housing. And other parts of the country, depending on the part of your country you're in, there really may not be a fundamental shortage of housing. There may be people who have income needs, but there is actually a surplus of housing. One of the metrics to look at in terms of what's causing it is, are we building housing where there's what's the relationship between market rents for a typical product type and restricted tax credit rents? And it does have to question whether or not building new housing where you're creating supply and not producing housing that will be rented at a cheaper rate is even beneficial. What are you seeing, Ellen, in terms of how allocating agencies are dealing with that?
I don't really have anything that I can to add on that.
Okay, good.
Wayne, this is Quinn. We're probably going to get into this here in a little bit, but it's interesting. We see a little bit of an appetite in Arizona, and one of the things that's since we're seeing CRA investment, and it's a CRA investment appetite that's somewhat driving that. We are seeing some more economic type investors that are coming into Arizona and looking at some specific markets within Arizona. I think it's largely just kind of driven by where certain CRA investors are in their CRA examination cycle. So they, as many know, it's a zip code driven type program and based on deposits and locations within the zip code. So the internal banks, the internal CRA officers in the banks are going down to their investment groups and their lending groups and saying, hey, we got to fill some buckets. And depending on how close they are to examination, they're kind of scrambling to get that done.
What types of investors are you seeing? Are there new investors that are entering the market?
Well, I think the predominant thing still is the banks, but we're starting to see this bifurcation you're referring to, where we have high yield investors, people who otherwise may not be motivated to do it. Quinn's thought this too, but I'm wondering if to some extent it's more anecdotal. It is a major impact at this point. We do know there are high yield funds where people are doing deals purely based on yield. There's only an announcement that Google put out some money, but Google invested in all of $25 million, which is really a bit of a drop in the bucket. The industry has been looking for a long time for this idea of corporate America stepping in and really changing the market around and add a lot to the supply. I think there's some, and another one notably that has invested, has a fund and has been buying is Berkshire Hathaway. Berkshire Hathaway also tried to buy the Fannie Mae and Fannie Mae portfolio with Goldman Sachs, and Treasury wouldn't allow them to do it. But so there, Berkshire is probably primarily driven by yield, but also with considerations of having complementary building projects. Google is great because that's somebody who appears to be a stranger to the space. In kind of the old days, Microsoft and some of the tech companies were buying, but it's very understandable why it's a hard sell to tech companies because it's outside their area, the product is very complicated, and they have very attractive alternate investments in their own area. The one place where I think we see more compatibility is like the insurance companies, and we're seeing them. They've been active in the state tax credit space and in the federal tax credit area, and they're buying, and I think they're looking at the higher yields, including some who had